Ever wondered how to decipher the hieroglyphics of stock charts? Or what those little candle-like figures mean in stock analysis? Welcome to the fascinating world of candlestick charting, a versatile tool used by investors to interpret price patterns in the stock market. This method of charting is like a language of its own, speaking volumes about market sentiment and potential price reversals. Originating from Japan over 3 centuries ago, candlestick charting was first used by rice traders to predict future prices. Today, it's used globally by traders and investors to analyze and predict price movements in the stock market. The beauty of candlestick charting lies in its simplicity. Each candlestick represents a specific time frame and tells a story about the open, high, low, and close prices during that period. With the right knowledge, you can read these charts just like a book. But what do these candlestick figures represent? Let's find out. A single candlestick tells a story of a day's battle between buyers and sellers. Imagine a candlestick as a knight. The knight has a head, a body, and a sword. In the same way, a candlestick has 3 main parts: the body, the upper wick, and the lower wick. Each part tells a different part of the day's story. The body of the candlestick is the heart of the action. It represents the range between the opening and closing prices of the day. If the body is filled or colored in, it means the stock closed lower than it opened. The sellers won the battle. If the body is empty or not filled in, it means the stock closed higher than it opened. The buyers won the day. The upper wick, or the head of our knight, represents the highest price that the stock reached during the day. The longer the upper wick, the further the price was pushed by the buyers before the sellers fought back. The lower wick, or the sword of our knight, represents the lowest price that the stock reached during the day. The longer the lower wick, the further the price was pushed down by the sellers before the buyers rallied. So if you see a candlestick with a long body and short wicks, you know that the battle was intense and one-sided. A candlestick with a short body and long wicks, on the other hand, tells you that the battle was fierce but indecisive. The color of the candlestick also has meaning. Traditionally, a black or filled candlestick signifies a bearish day, where sellers pushed the price down. A white or hollow candlestick signifies a bullish day, where buyers pushed the price up. So that's your basic candlestick, but there's more to it. The color and the shape of these candlesticks can tell us about the market sentiment. When the bulls rule the market, we see specific types of candlesticks. Now let's delve into the world of bullish candlesticks, where the optimism of investors is reflected in the design of these candles. Primarily, we have the bullish engulfing candlestick, a dynamic duo of candles that signifies a potential reversal in market sentiment. The first candle, smaller and bearish, is followed by a larger bullish candle engulfing the previous one. This is the market's way of saying, the bears had their fun, but it's our turn now. Then we have the hammer. No, not the tool, but a bullish candlestick that resembles it. The hammer forms when the market opens, prices drop, and then they rally to close near the opening price again. This leaves a long lower shadow or handle and a small body or head. It's as if the market is hammering out a bottom, indicating that the bulls are beginning to step in. Finally, we have the morning star, a celestial sign of hope for bullish investors. This 3-candle pattern starts with a long bearish candle, followed by a small-bodied candle that gaps down from the first candle, and ends with a large bullish candle that closes within the range of the first candle. It's like the dawn of a new day after a long night, suggesting that the bulls have taken control from the bears. But here's the catch. No matter how bullish these candlesticks might appear, they're not a magic crystal ball. They can give you a sense of market sentiment and potential future price action, but they're not infallible. Always remember to consider other factors like market news, economic indicators, and your risk tolerance before making any investment decisions. These bullish candlesticks might be a signal to buy, but remember, one candlestick alone is not enough to make an investment decision. So keep your eyes open, your mind sharp, and your analysis thorough. After all, in the world of trading, knowledge is power. What happens when the bears take over? The candlesticks tell the tale. Let's delve into the world of bearish candlesticks, signs that the stock price may be about to take a dip. 3 of the most common bearish candlesticks are the bearish engulfing, the hanging man, and the evening star. Let's start with the bearish engulfing. This is a pattern that appears after an upward trend, and it's a strong indicator that the bears have taken control. The bearish engulfing consists of a small green candlestick followed by a large red one. The red candlestick's body engulfs the green one, hence the name. This indicates that selling pressure has overwhelmed buying pressure and could signify a reversal in the market's direction. Next, we have the hanging man. A rather ominous name, isn't it? Well, it's appropriately named as it could be a sign of doom for the current upward trend. The hanging man candlestick has a small body and a long lower shadow, kind of like legs dangling down. It forms when the stock opens and closes at a high level, but also experiences a significant drop during the trading period. This suggests that the bears are starting to claw back control and the bulls may be losing their grip. Lastly, we have the evening star. As poetic as it sounds, it's not a good sign for those hoping for a rise in stock prices. The evening star is a 3-candlestick pattern that signals a potential top of an uptrend. It consists of a large green candlestick followed by a small-bodied candlestick that gaps above the first one, and then a large red candlestick that sinks into the body of the first one. This pattern suggests that the bulls have exhausted their strength and the bears are ready to step in. Bearish candlesticks could be a warning sign to sell, but always look for other indicators before making your move. The world of stock trading is complex, and it's always best to use all the tools at your disposal. Remember, knowledge is power in the stock market. So now you know the language of the candlesticks. We've discussed the basics, delved into the bullish and bearish candlesticks, and discovered their implications on the stock market. Bullish candlesticks with their long bodies and short shadows indicate potential upward price movement. Conversely, bearish candlesticks, characterized by their long upper shadows and short bodies, suggest the possibility of a downward trend. However, it's important to remember that these candlestick patterns should never be used in isolation. They are just one piece of the larger puzzle that is market analysis. Combining them with other technical analysis tools, like trend lines and moving averages, can help you make more informed and potentially profitable investment decisions. The language of candlesticks is a powerful tool to have in your trading arsenal. It's like having a decoding ring for the stock market, offering insights into potential market trends and investor sentiment. Remember, candlesticks are not fortune tellers, but they can give you a good idea of where the market might be heading. Happy trading!